Most people think about money in very obvious terms: income, expenses, and investments. They track paychecks, calculate how much to save, and occasionally check their brokerage account to see if their portfolio has grown. But there's a layer beneath all of that, one that few consciously build, yet it's often more powerful than any paycheck, bonus, or market return. This is what I call a shadow portfolio. It's not a fund or an account you can log into. It's the invisible system of optionality, leverage, and time that quietly compounds in the background. And understanding it changes the way you think about money entirely. A shadow portfolio is your unseen financial leverage, the assets, skills, relationships, and cash flow engines that aren't formally tracked in your net worth statement, but which quietly expand your economic freedom. Unlike a traditional investment portfolio, which you can measure in dollars and percentages, the shadow portfolio is about potential and optionality. It's the combination of decisions, positions, and resources that allow you to deploy capital, take calculated risks, and convert labor into choice rather than just income into consumption. To most people, it sounds abstract, but once you quantify it, the numbers reveal a stark truth. Your standard income alone is often the bottleneck in your long-term trajectory, while the shadow portfolio determines how quickly you can scale autonomy and freedom. Take the average professional earning $100,000 a year with a 20% savings rate. They might be able to invest $20,000 annually, and with a 7% compound return, they'll have roughly $540,000 after 20 years. That's respectable, but incremental, an improvement in lifestyle, not a transformation. Now, imagine the same person has built a shadow portfolio alongside this. Consulting relationships that generate $5,000 in variable side income, a small ownership stake in a private business, and skills that could convert into $10,000 per month if leveraged correctly. Suddenly, the same 20-year horizon doesn't just produce $500,000, it produces flexibility, optionality, and multiple streams of cash flow that compound not just financially, but structurally. The difference isn't the rate of return, it's the deployment of leverage that isn't visible on a spreadsheet. The real power of the shadow portfolio lies in its effect on decision-making and risk tolerance. When all your wealth is tied to a salary, every financial choice is constrained by that income ceiling. Take a professional earning $120,000 per year with $3,000 in monthly expenses. If they lose their job, lifestyle creep ensures that their buffer disappears quickly. But a shadow portfolio, consisting of part-time consulting contracts, scalable intellectual property, or deferred equity arrangements, creates a safety net that is independent of that income. This converts risk from a binary I earn or I fail scenario into a spectrum where each decision can be evaluated in terms of optionality, not fear. The psychological baseline itself shifts. You start to think like a business owner with multiple levers, not a consumer living paycheck to paycheck. Let's make it more concrete. Suppose you identify a niche skill that, if marketed to the right audience, can produce $2,000 a month on the side. The time cost is minimal, perhaps 5 hours per week, and the leverage is effectively infinite because the knowledge can be reused, packaged, or scaled. Over 5 years, with modest growth and compounding, that side income could approach $150,000 cumulatively. Compare this to investing $2,000 annually in a traditional index fund with a 7% return. That produces roughly $12,000 over the same period. The shadow portfolio, when properly identified and executed, multiplies the conversion of effort to freedom. This is why focusing only on traditional savings rates and investing misses the bigger picture. The invisible engines of autonomy are what actually accelerate financial independence. Another aspect is the compounding of knowledge, relationships, and credibility. Unlike market returns, which are probabilistic, these elements compound exponentially through optionality. Every skill acquired, every relationship nurtured, every small stake in a venture or side project adds nodes to your network of leverage. After 10 years, this can mean the difference between a person who has a portfolio of $500,000 and a person who has the same amount of visible wealth but can generate $50,000 per month in deployable opportunities. The numbers on a statement look identical, but one individual has true freedom, the other remains tethered to conventional constraints. Shadow portfolios also change the lens through which we view consumption. Many people confuse wealth with lifestyle appearance. They spend money to look wealthy, not to create leverage. The hidden truth is that deploying capital into things that generate optionality produces compounding effects far beyond the superficial satisfaction of a new car or vacation. Buying a $50,000 car depreciates instantly and narrows optionality. Investing in a $50,000 small business stake, a knowledge asset, or a high-leverage skill expands optionality, improves profit margins, and accelerates freedom. Over time, the opportunity cost of lifestyle creep dwarfs the returns from conventional investing if your shadow portfolio remains undeveloped. Understanding this also reframes risk. Traditional financial advice focuses on diversification, asset allocation, and avoiding debt. Shadow portfolio thinking focuses on asymmetric risk, where the downside is limited but the upside scales dramatically. A freelancer creating digital products, a professional monetizing expertise, or an employee leveraging a skill to negotiate equity all occupy this space. The key is to build channels that are independent of your current salary, scalable over time, and rooted in skill or leverage rather than luck. The final takeaway is simple but counterintuitive. Visible net worth tells only half the story. Real financial power comes from the invisible scaffolding, the shadow portfolio that supports optionality, autonomy, and compounding freedom. Two individuals with identical bank balances can occupy entirely different trajectories if one has cultivated hidden levers of leverage. Your income is a tool, not the endpoint. How you build, deploy, and grow your shadow portfolio determines how quickly you convert labor into liberty, how insulated you are from lifestyle creep, and how exponentially your long-term trajectory can accelerate. Start thinking beyond the obvious numbers. Map your hidden assets, skills, and scalable opportunities. Calculate the compounding effect of each small investment in yourself or your leverage nodes. Because the truth most professionals overlook is this: wealth isn't what shows up in your brokerage account. It's the optionality you control, quietly growing in the shadows, waiting for you to deploy it when it matters most. That is where real financial freedom resides.